So as with the last video, I'm going to try to give you a more intuitive idea what's going on with these. So basically, the idea is what we want to do here is we're going to do an analysis of these accounts, and here's the information from last year, and of course we'll have to compare all this information to the information for this year. So we're going to need to calculate all these ratios, then of course whatever ratios they ask us for down there. And the first thing we need to do is we need to figure out a few things. So a lot of these have to do with dividends. So the first thing you want to do when you get the question is figure out the dividends, or how much dividends we paid out. So you can see our preference shares are worth 40,000. And for those 40,000, they're guaranteed to get 4% dividends on that. That's what that means. So let's get 4% of 40,000. That's 0.04 times 40,000, which is equal to 1,600. And that's our preference dividends, which we're going to call PD. And this is important, so I'm going to put a box around it. And from that, we can figure out our ordinary dividends, because we know how many dividends we paid, which is this much. So basically, the total dividends is equal to the preference plus the ordinary dividends. So we know the total is 20,000. We know the preference is 1,600. We want to know the ordinary dividends. So you can just subtract that, bring that to the other side. You get ordinary dividends equals 18,400. Again, that's also important. We'll be using that. And then the last thing is the operating profit, which is defined to be the net profit before interest. So you can see here's the net profit, and that's with 12,000 interest taken away from it. So if we want to find it before interest, we want to add that back on. So since we took it away, now we're going to add it back on. It's going to be 122,000. So basically, this is our profit, and then we took 12,000 interest away, and we got 110,000. We just added it back on to see what it was before we took the interest away. And they're the only three things you have to calculate, and then you go into the ratios. So I'll just go through the ones in this question, but you can kind of use the same logic or similar logic to kind of figure out the other ones. I'll go through a few other ones as well. So earnings per share, right? So basically, there's two types of things you're going to use. You're either going to, when you talk about earnings or profit, you're either going to say your net profit minus preference dividends, and this is for anything to do with shares / dividends. If you're talking about profit, it's going to be that. Otherwise, you're going to be using operating profit unless they say otherwise. So for example, they might ask for the net profit percentage or the net profit margin. In that case, obviously you're going to use your net profit, but otherwise you're going to use these. So basically the way that I like to remember it is you use this for basically all of them, and use this one only for return on capital employed and interest cover, which you'll see as we go on. So earnings per share, that's something to do with a share. That means we're going to be using this. So that's our earnings, is our profit. So for our earnings per share, well, obviously we need to see how much did we earn. That's our profit, which is going to be our net profit minus the preference dividend. So basically, you want to see what the profit is, not taking, or the profit is after because we have to pay out these dividends, and then we're going to see how much money we have left over. So since this has to do with dividends, we want to take out the ones that we have to pay and see how much profit we have left over. Again, kind of like the little rule I said. And we want earnings per share. So we just divide. We have our earnings, per means divide, and then the number of ordinary shares. So whenever it says share here, or it says per ordinary share, so we divide it by ordinary shares. How many ordinary shares do we have? We have 400,000, as you can see there. So our net profit is 110,000 minus our preference dividends, which is 1,600. All over our ordinary shares, which is 400,000. What's that equal to? And since these are both in euros, so that's that profit in euros, ordinary shares, how many there are. Well, that's actually how many ordinary shares there are. It's the number of shares. So what we have is euros per ordinary share. So that what we get is we get 0.271. So remember, that's in euros because this is in euros, and that's so that's that many euros. And then since on the bottom we had shares, if you kind of do a little dimensional analysis, we have money per share. So this is going to be in euros per share. Or you can change it to 27.1 cents per share, which is usually what they do. You can see that's an improvement, big improvement. So we'll give that a little box. So it's earnings per share. Dividends per ordinary share. Okay. Now, since we're talking about ordinary shares, you're going to be talking about ordinary dividends as well. So let's see how many ordinary dividends are there. Per means divide, per share divided by how many ordinary shares. So very simple. 18,400 is our ordinary dividends. All over our ordinary shares, 400,000. Put that into your calculator or your calc if you're using slang. 400. And again, that's going to be in euros per share. Again, same for last time. I'm going to convert cents, 4.6 cents per share. Because I got 0.046 and multiply by 100 to get into euros. Okay, what do we have next? I'm actually going to pull it down just for ease. If we'd like to move, please. Why is it? Okay, I got it to move. And I have the important information too. So interest cover, that means basically we want to pay off our interest. What do we pay off our interest with? Well, we pay it off with however much profit we have. So basically, we need to see how many times can we cover our interest using our profit. Now remember, this is nothing to do with shares, and it doesn't say what type of profit we should use. So that means we're going to use operating profit because that's nothing to do with shares or shareholders or whatever. So we do operating profit. We want to see how many times does our interest fit into that operating profit. Okay. Again, because we want to see how many times, how safe are we? Here we can cover it 5 times. So that means, that's good. We have tons of money left over compared to how much the interest is. So our operating profit is 122,000 over interest is 12,000. Put into calc, and always give 2 decimal places is 10.16, and that goes times, because how many times does it fit in? Technically, whenever you do division and the units are the same, the answer is in times, and since it's euros over euros, it's just times, it's just the unit. So for example, how many times does 25 go into 20? It goes in 4 times because they're the same unit. Quick ratio, so quick means what things can you get rid of quickly. So it always talks about the current assets minus the closing stock is to current liabilities. So basically you want to see what's the ratio between how many assets we have and how many liabilities we have. So liabilities are things we have to pay off. Assets are money that we have that we can get, or so like debtors that's owed to us. We need to see if this is more than the current liabilities, then we're going to be able to pay them off. And then quick means we can get rid of it quickly. We can't get rid of closing stock quickly because other companies don't really want to buy our closing stock because it's just stock for us to use. So that's why this is the quick ratio, sometimes called the acid test ratio, or the quick ratio, because it's stuff we can sell quickly. So come up here, current assets are 126,000. Minus the closing stock, opening stock, cost of goods sold. Right, I'm not seeing closing stock here, and the reason for that is because they ask us to figure out what is closing stock here, given the stock turnover. So I'll go through that formula. Yeah, I think I'll go through it now. Actually, no, I won't, because it's a little complicated. We'll go through these first, and then I'll come back to this one. It's unfinished. Give it a little start. Return on capital employed. So this is the other one that uses operating profit. So return means how much money you get back. So that's your operating profit. And then capital employed means all the capital in the company, all the money that makes it up. That's this number here. So it's adding up all the capital. How much do we get from a loan? How much from shares? And how much profit did we make? 705,000. So over the capital employed. So return means the money we made. Capital employed means all the finance going into the company. So our operating profit was 122,000. And our capital employed was 705,000. And another thing is, if you see 3 zeros on the top and bottom, they cancel. I often just write 122 over 705. And then that'll give you, that's per cent. You can multiply by 100 to make it more clear. You get 17.30%. Market value of a share, we're given that here. Don't need to write it down. Gearing. Gearing is basically your ability to pay off, or how much gearing. What gearing means is how much of your company is made up by debt in the long term. So obviously asset test ratio, you have to do it short term, current and current. This is long term. So basically, in every question there's 2 types. There's debt, which is your debentures because you have to pay it back, and the preference shares because you have to pay them dividends. You have no choice. And then the other part, which is the ordinary shares and the profit and loss balance. That's kind of like it's called shareholders funds. Well, that's one word you can give it. Shareholders funds, because this is stuff that they don't have to pay off. It's stuff that they own. So ordinary shares they don't have to pay dividends on, and then it's just the profit they made in the year. So basically, we want to see how much of our total capital employed, all of the money that makes up the company, how much of that is made up by debt as a percent. So basically, we take our debt, which is called fixed interest debt because there's interest on it and it doesn't change. At least in this case, it doesn't. Over how much money is it made out of, which is 705,000. That's called the capital employed. So that's the one for that. So how much debt is there? 150,000 is a loan, so obviously that's debt, and then 40,000. So we have 150,000 plus 40,000 over the capital employed, which is 705,000, which is equal to 109 over 705. Multiply by 100 if you want to make it look easier. Sorry, not 109, it's meant to be 190 when you add those. Still very low though. We get 26.95%. Then dividend cover. It's kind of similar to interest cover. We want to see how many times do our dividends fit into our profit. So the reason we want to see that is not super obvious, but it does make sense if we look the other way around. But I'll just do it for now. So our interest cover was how many times does our interest fit into our profit? So basically how easily could we pay it off? Here it fits in 10 times, so we have 10 times more profit than we have interest. Here we want to see how many more times profit do we have dividends. Except we're not going to use operating profit. Remember, if it has anything to do with dividends or shares, we use net profit minus the preference dividends, and then divide that by the ordinary dividends. We want to see how many times does the ordinary dividends fit in. It says dividend cover, it means ordinary dividend cover. It just doesn't say that because it's silly. So net profit is 110,000. 110,000. This is the preference dividends is 1,600 divided by how many ordinary dividends there are, which is 18,400. 400 and calc, and we get a nice number of 5.89 times. So that's how many times it fits in. So basically what that means is we're not paying, compared to our profits are almost 6 times bigger than our dividends. A nicer way to interpret it is if you do the reciprocal, which tells you, it's called the percentage payout, is if you do it the other way around. So if you do ordinary dividends over net profit minus preference dividends, that tells you out of your whole profit, how much of that is ordinary dividends. So if we just do 1 over this, it'll give us that, or you can use this formula. If we do 1 over 5.89, that'll give us 16.98%. So that means that 16%, almost 17% of our profits is paid out as dividends. You can use that in your analysis if you want. And then dividend yield. So basically, I skipped over dividend per share, did I? Or no, I did do it, sorry. So dividend yield basically means a percentage of how much are we getting out of it. So basically we want to see how much our dividends are getting out of the share. So we go buy a share for, in this case we buy a share for €1.25. How many dividends are we getting out? Well, we're getting 4.6 cents for each share we have. What's that as a percentage? That's what a yield is. A yield means how much you're getting as a percentage. So for that one, this dividend yield, we take our ordinary, or our dividends per share. So we want to see how many dividends do we get in each share and divide it by the market price of a share. So basically we get 4 dividends, 4.6 cents. And remember that, make sure the units are the same, divided by 125 cents. Because that's how much the market price of the share is. And now we get to see as a percentage how much of the 125 cents are we getting back. We're getting 4.6, so 4.6 over 125 times 100 to get it to a percent. We get 3.68, and that's in percent. So that tells us that the dividend, how much dividend we get for each share is 3.68% of how much that share costs. And that's it. So you can see, all very logical, not too hard to remember. Now we're asked to do this. So the rate of stock turnover, So this is for part 1 now. So the rate of stock turnover. So you got to understand a few things for this. So if you think back to question 1, the cost of sales, it doesn't really mean cost of sales because all it has to do is is stock. So cost of sales, at least in higher level anyway, it's your opening stock plus your purchases of stock minus closing stock. So that's all to do with stock. It's basically how much stock did we use this year? We used our opening stock and however much stock we bought minus the closing stock. That's how much stock we used in the year. And basically what the rate of stock turnover, I should have said, rate of stock turnover is it basically says how much stock are we holding on average. How many times does that fit into how much stock we use in the year? So basically we're trying to see how much stock we have on average, how many times does that fit into the stock that we had during the year, or in other words, how quickly are we getting rid of it? And I guess the easiest way to see that is through an example. So basically the formula for it is your cost of goods or cost of sales over average stock. So because this is a bit of a complicated question that they give us, but to give it an easier example, let's say a cost of sales is 100,000. Now remember, this doesn't mean 100,000. It means 100,000 stock we used in the year, purchases and plus opening stock minus closing stock. Over, and let's say on average, the stock that we held during the year on average was 20,000. Well, that means that the answer is 5. That means that basically whatever stock we have on average throughout the year, we got rid of that 5 times. Because obviously we had 100,000 throughout the year. On average, we're holding 20,000. That means we got rid of that 5 times. So a high stock turnover is good because it means that you're always getting in new stock and getting rid of it quickly. If you have a low stock turnover, that means you're holding a lot of stock, that you're not getting rid of it. So if this is 100,000 over 100,000, that would make the ratio 1, which is lower, and that's a bad thing because that basically means that we had stock for the year. 100,000 is how much we bought and we had in the year, and how much stock did we hold on average is 100,000. That means that we didn't do anything with that stock. That's a bad thing. That stock is going to be depreciating and losing value. We might have to pay insurance on it. It's better to have a higher rate of stock turnover. Now your average stock, I hope that made sense by the way, is the average of the two stocks you're given. So it's open plus closing over 2. So in this question, we don't know the closing stock. We need to figure that out. And we know that the rate of stock turnover is 10. So our cost of sales is 605,000. So the return on stock turnover is 10, or the rate of stock turnover. 605,000 is our cost of sales. Let's see what our average stock is. So it's opening stock plus closing stock over 2. Opening stock 65,000. Closing stock we can call X, because why not, all over 2. So basically our average stock is, this is whole thing is over. And it might actually be easier if you're not good at working with fractions and maths, right, at 0.5 times that. But I'll just use a double fraction because why not? So we have 65,000 plus X over 2. So we have fractions inside fractions here, which is not ideal. But basically what we can do is we can bring this up to the other side because it's on the bottom. Bring it up to the other side as multiplication. So I'll do it fully out. 65,000, plus X over 2. We have that whole fraction multiplied by 10. That's equal to 605,000. So we can simplify here. 10 divided by 2 is 5. So you have 5 multiplied by 65,000 plus X equals 605,000. Now you could multiply that 5 in, but if you're smarter, you could divide both sides by 5. Because if you divide 605,000 by 5, you'll get 121,000, which means that X equals 121,000 minus 65,000, gives you 56,000, and give it in euros, it's euro 56,000. And that's our answer for part 1. Now that we know what our closing stock is, we can finish off this acid test ratio, so minus 56,000. And that is to the current liabilities, which is 75 or 51,000 here in total, you can see. Then you subtract them and you get that's where the 75. So this is 51,000. And again, this tells us how easily will we be able to pay off our current liabilities. So if we simplify this one, 26,000 minus 56,000 is 70,000 is to 51,000. That's kind of like an equation. We can divide both sides by whatever we want. We usually want the one on the left to be the bigger number, always. So we'll divide both sides by 51,000. So 70,000 over 51,000 is 1.37 is to 1. So divide this side by 51,000, you get 1. Divide this side, you get 1.37. That means that we have 1.37 of liquid assets. So that's why it's the quick things we can sell quickly, you call them liquid, for every one of a liability. So basically, if we had to pay off all of our liabilities, that's no problem. We can do it because we have 1.37 times more of our assets, which are good things, and we can get rid of them easily. We can get rid of them quickly to pay off those. So yeah, that's a good thing. Return on capital employed is part 2. So that's this one. That's our answer for part 2. For part 3, we want the price earnings ratio. So this one's quite easy. Price is to earnings. Ratio you can write as a ratio or as a fraction. So price is the price of a share, and then our earnings is our earnings per share. So remember how I said the units have to be the same? So if this is the price of a share, we have to talk about earnings per share for each share. Whereas if we talked about total earnings but only one share, it's not really reflective. They have to be the same. So we have 125 cents or €1.25, and then our earnings per share was 27.1. And that's in cents, so they have the same unit. They'll cancel. That's nice. 125 over 27.1 equals 4.61. And then that's a ratio. It's just times. How many times does this fit into that is all it means. And yeah, so basically it means it fits in this many times. So that means that basically each share earns 27.1 cents of profit. That means after 4.61 years is actually the unit that they usually want it in. Sorry. So if every year one share earns 27.1 cents, that means that after 4.61 years, a share will have earned its value. So basically, it's kind of like a share will earn back its value after this many years. That's what the ratio tells us. Gearing, we did that, and dividend yield we did. Okay, so part 4, gearing, that's here. And then dividend yield, we did here. Okay, I'm going to do a few more just because they can come up, but they didn't come up here. So one that comes up quite a bit is the period. Oops. We'll just do it for this because why not? So period given to debtors or creditors to debtors. Okay, so remember, debtors are people that owe us money. So they're basically kind of like sales for us. We sell them stuff and they give us money for it. So basically how we do that is you want to see, we have debtors, obviously. They owe us money. Out of all of our credit sales, how much of those are debtors? Okay, so basically what we're saying is that depending on how much of our credit sales, credit means they didn't pay straight away, they owe us money, which is what debtors are. They are people who have bought stuff from us that we sold to, but don't owe us, but they haven't given us the money yet. We want to see how many of them, out of all of our sales, how many of them are debtors, and that'll tell us how long time we should give them to pay us back. So to think of this numerically, let's say our credit sales, for example, was 100,000, and our debtors was like 20,000. Okay, so because our debtors are a smaller amount compared to our total sales, we don't need to give them as much time. In this case, we have to give them 0.2. What unit you might think? Well, this is credit sales for the year. This is debtors for the year, so this is in years. So if you wanted to get that to months, you'd multiply by 12, because that's how things work. So usually it's in months, so you'd have 0.2 times 12, which is 2.4 months. So that's basically how that works. Or then, for example, what if we had 90,000 over 100,000? So that means our total sales is 100,000 and debtors is 90,000. That's going to give us 0.9 years, which is equal to, multiplied by 12, 0.9 years. So do 0.9 times 12. That's 10.8 months, right? So I might be thinking, what value does this have? Well, obviously, if our debtors is smaller compared to how much we are owed overall, then since it's a smaller amount, they don't need as much time to pay it off. But if it's a bigger amount compared to how many sales we made overall, then they need more time to pay it off, 10.8 months. That's how that ratio works. So because it's usually months, to get months, you multiply by 12, and that's the formula for that. I won't do it out for this because I think that gave you a good understanding of it. And then period given to creditors is a similar thing. So creditors means people we bought things from on credit. So we take our creditors and we divide it by how many things did we buy on credit. It's called credit purchases. Often they'll tell you what this period is, and usually it's in months, so you multiply by 12, and that's maybe it could be 10. And you don't know what they ask you to find what is cash purchases, for example. So what you would do is you'd figure out what credit purchases are. So you know this, you know this, you know this. You can solve for credit purchases, bring it up there, bring that down there. And then we know that total purchases equals cash purchases plus credit purchases. And you can find total purchases from the question. Purchases, or not in this question apparently. Okay, usually they'll give it to you in the question if they do ask you, but they didn't ask in this question. Then you know the total, you know the credit from this, then you figure out the cash is how that works. So that's another important formula. Similar to the quick ratio, which is things we can sell quickly, you might also be asked for the current ratio. So current ratio just means our current things as a ratio to each other. So the current ratio is just current assets is to current liabilities. So it's just taking our current things and putting them in a ratio to each other, whereas our quick ratio was a ratio of how many things can we sell off quickly, which doesn't include our closing stock, to the things that we owe short term. So that's called the, how did I already forget the name again? It's called the current ratio. Sorry. Yep. Sometimes they also ask you the return on shareholders' funds. So remember how I said shareholders' funds is what makes up the company. So the company is made up of debt, which is your debentures because you have to pay them off, and your preference dividends because you have to pay out the dividends. You have to legally. They're your debt, and then your shareholders' funds is the other two. So your shares and also your profit and loss balance, which is kind of like your profit for the year, kind of, that you're keeping in for the company. That's your shareholders' funds. So remember return. So think of return on capital employed. That was the profit we made. How much of that was out of the capital employed? As a percentage, how much of our profit, how big is our profit compared to our capital employed? So return on shareholders' funds is quite similar. It's basically the return, but because it has to do with shareholders, we're not going to use operating profit. We use net profit minus preference dividends, as we do always with things to do with shareholders. And then instead of dividing by capital employed, we're going to divide by shareholders' funds. So in this case, net profit minus preference dividends. Net profit 110,000. Our preference dividends are 1,600 divided by shareholders' funds, which is going to be 400,000 plus 115,000. 400,000 plus 115,000. And you usually won't use this figure in your analysis in the report because they don't give you the numbers from last year. And it's also just not as useful to people as the other one, the return on capital employed. Multiply by 100 to get the percent. And you can see it's about 21.05%. If you had to calculate that. Sometimes they'd ask how long will it take for your how long will it take to recoup the share price given the ordinary dividend payout? So that basically means, remember our price to earnings was how long will it take for the earnings on our shares to become one share? So if we're getting 27.1 cents earnings every year for a share, and it needs to get up to 125, which is the price of the share, it'll take 4.61 years to reach that. Well, this one is similar. So this is called the recoup based on dividend. So they haven't asked this one in ages, since like 2010, but still good to know. So it's the same thing. We want to know the market price of a share, and we divide that by the dividends per share. Okay, I'll explain that now after I do the calculation. So it's 125 is the market price. Then dividends per share was 4.6. So 125 over 4.6, which is equal to 125 over 4.6, 27.17. Since these are all for the year, that's in years or times, but it's technically should be in years. Because what does this mean? Well, basically, this is how much a share costs. We purchased a share for this much, and as a shareholder, we earn this much in dividends. So you might be like, okay, how long will it take for us to earn back what we paid for the share in dividends? Well, if we're getting this much every year, it'll take 27.17 years to get 125 if we're getting 4.6 every year. That's what that means. Sometimes they'll ask you what do you think, what is the market price of the share? And usually they'll say because of the price earnings ratio, but sometimes they won't. So if they ask you what is the market price of the share going to be, you use this formula. Okay. So if we rearrange, so they'll only ask you this if they give you the price earnings ratio. So we can find the market price of a share that's equal to the earnings per share multiplied by the price to earnings ratio. If you need to find the market price of a share, but again, they'll usually say find it if the price to earnings ratio is this. So you don't have to worry about that one too much. Just think about they'll mention price earnings ratio, and then you'll know, I have to use that formula. So you don't have to memorize that one really. The last ones that they could ask, but they don't really ask, is gross profit margin. That basically means out of all of our sales, how much profit did we make out of sales? That's just gross profit over sales. And that's a percentage. So for example, if we made 10,000 profit and we sold 200,000 things, that basically means that 10 over 200, that basically means that 5% of what we basically took, everything that we sold, we made 5% profit off of what we sold. That's basically what that means. They also might say net profit margin. Same thing, just net profit over sales. If they say markup, or this can also sometimes be called the percentage. Again, these are just random names given to them. Unfortunately, you do just have to memorize these. If it says the markup, then they're talking about the cost of sales. So we see that's our gross profit over the cost of sales. So let's say we earned 10,000 and it costed us 100,000 to do the sales. That means that basically it's 10%, which means that 10% of what we spent on products was made in a profit, which is good. So that means we made a 10% profit off of what we spent on the sales pretty much. And same for net profit markup. They've barely asked these ones, so don't worry too much. That's literally everything they could ask you, and I think I explained pretty well the logic behind them, so you don't have to memorize them. And that'll also help you in the report. So in the report, you explain, is it good compared to last year? Did it get better? Did it get worse? And you also explain, what does it mean? So, for example, I'll try and make another video, but I think you're okay with it. For example, dividends per share, or dividend yield's a good one, right? So dividend yield basically means this is the percentage I'm getting off of my investment. I paid this much, I'm getting this much in dividends. That means I'm getting 3.68% return on this. So basically you'd say, right, in your analysis, what does this mean? Basically, they're getting 3.68% of a return on what they invested. So getting 3.68% in dividends of their the share. Then you'd say basically this is last year it was 5%, so it's a bad trend. It's gotten worse. But if you were investing in a bank, you'd get somewhere between 1 to 3%. So it's above that, so it's good. That's the kind of analysis. If you can understand what they mean, which I hope you do after listening to this, you should be able to write about them.